Hello everyone, welcome back to the USA Gold Weekly Review and Outlook. Today is Thursday, July 20th. I am Jonathan Casares. This is Peter Grant with me as always. So, pretty good couple of weeks for the gold price, all things being equal. Silver as well. You know, basically we kind of saw some middling there around the lows in the low 1200s. Silver went all the way down into the 15s. Silver gold ratio went to like 78 to 1. I mean, it was the weakest it has been in a very, very long time. I mean, the weakest we've ever even seen is like 82, 83 to 1. Right. So we're kind of getting right up into that. But lo and behold, in the darkest of our hours, both metals have recovered. And by darkest of our hours, I simply mean look anywhere in the last couple of weeks and people are starting to call for 1130 gold, a breakdown in the market, etc., so forth.
I didn't get dark at all. I mean, I thought that it was a very reasonable pullback. Certainly in the gold market it was, and held right where it needed to hold, and bounced right back up. And we had been watching 1230 as an important resistance level, got back above that, got back above the 200-day moving average. Right. And right now we're into resistance, important resistance level, 1248 to 1250-ish, where the halfway back point of the June-July decline comes into play, and then also the 50 and 100-day moving averages are right there as well. So if we push through 1250, I think it returns quite a bit of credence to the dominant uptrend that has been in place since the beginning of the year. Yeah,
I would agree, and that is an important level, and we are right there. You know, I mean, even today, gold was down a little bit early, but then now back up about $5, right in that 1246-ish range. So, I mean, we are knocking on that important technical level, which, you know, I think it's interesting because, yeah, here we were just a week or two ago, and it felt like everywhere you looked, it was this overwhelming bearishness. But, yeah, I mean, I think as you step back and you look at this and you see what gold has done, and I mean, it's basically become a range-bound trade, but in a productive way. I think at worst you're seeing a consolidative tenor here between like 1210 and 1300, and holding that 1210 level was important to confirming that consolidative tenor. Or you're maintaining a consolidated tenor within an uptrend, which is an even more, you know, bullish or productive outlook on the market as a whole. And so, yeah, I mean, getting through 1250, it does bring back in, you know, likely a challenge of that $1,300 level as bullishness reasserts itself. And who knows, you know, that's kind of right where we've been watching all year. We've kind of just failed right there a couple of times, gotten super close without actually getting the job done or actually holding above that level. But yeah, I mean, it doesn't seem like it needs much to kind of go after it again.
No, and I would agree with that, particularly in light of what we frequently refer to as the summer doldrums. To be experiencing this kind of support in the middle of summer here, I think is really encouraging.
Agreed, and after those paper slaughters a couple weeks ago too, I mean, we've seen some nice resilience in the market.
Fade those. Fade those and fade the doom and gloom from the press. Yeah. I mean, the financial press, as we know, their bread is buttered by the traditional asset classes. Right. And so anytime they can bash the non-traditional asset classes, they're going to do that. And again, I think it's an indicator almost. You fade it.
I agree.
And you buy them.
I agree completely. So moving on to news. Biggest news, I guess, is ECB meeting. You know, minutes, everything came out today, press conference. Or not minutes, but sorry, the meeting and their decision. Yep. And so it came out today, and basically, you know, there was some expectation that they would be a little more hawkish, that they would start to at least discuss the quote-unquote punch bowl, but they didn't.
Right, held steady, everything status quo, interest rates, the level of QE, and no mention of taper, and they maintained the verbiage that said that, you know, we may actually increase QE if necessary. So that took the market a little bit by surprise. Bund yields fell along with the euro initially, but when Mario Draghi's press conference started, he maintained a very optimistic tone about the European economy. And there was some implication that maybe after the long August break that they would indeed be discussing the taper. And then the euro flew back up and in fact set near 2-year highs. That pushed the dollar to about 11-month lows and helped support the gold market. I know. Fresh gains, 3-week gains in gold.
Exactly. And isn't it interesting? It would seem the ECB is starting to learn a bit from the Fed that you need not actually do anything. You need only talk about potentially talking
You don't
about.
even need to, yeah,
You just
exactly.
talk about talking about doing something, and then the
Right.
markets go, it's craziness, really, but it is remarkable that, yeah, he can come out and talk about the strength of the economy, and they can say, oh, okay, well, they didn't talk about it this time, but, maybe next time, so I think we should trade it as though he is going to talk about it next
Right.
time.
They talked about possibly talking
He's
about it.
talking.
So I don't know who said it, and I'm sure a lot of people have, but I think you really judge both people and institutions not by what they say, but by their actions.
Exactly.
And I think or lack of action, and I
Right.
think the lack of action by the ECB speaks volumes.
It does. I would agree with that. And so, and then kind of, segueing that into Fed and where we're kind of at, I think it's an interesting dichotomy because, here we're tightening, and I think that there was definitely that expectation that the ECB was going to follow suit. And they were going to kind of take that page from the Fed about how to properly drain the punch bowl and, kind of move slowly away from it and everything. But they're still kind of, moving in different directions. And maybe, we will come into the fall and after the August and the ECB will start talking about, potentially being more hawkish right at the same time as the Fed, maybe starts moving away from their hawkishness or at least, as we center
Right.
around that September meeting.
Right, and so inflation data last week was terrible. Both
There is
CPI and PPI continued to slow, and so they can't really, the Fed can't really make the claim anymore that the weakness in inflation is transitory. It's been 4 or 5 consecutive months right now, and so that caused September rate hike expectations as measured by Fed funds futures to crater. It's below 10% right now. So it's essentially, in the market's view, off the table.
Right.
I had an expectation that they would, in reaction to that, they would ramp up hawkish speak to try and at least get it back on the table so they had the option to raise rates in September. But they've been very quiet. And Jim Rickards said this week that he thinks it's off the table, that the Fed has raised the white flag and surrendered on September, and they'll live to fight, hopefully, maybe, possibly in December.
Yeah, but he's always been a believer, if you will, that they will ultimately just reverse policy.
I think they're going to have to. And we've talked about this before, that the whole purpose of raising rates into economic weakness is to give yourself some clearance above the zero bound so that you can cut.
Right.
Historically, they need 300 basis points. They're nowhere close to that.
No.
They're about halfway.
And I mean, at this pace, I don't think they have enough time.
They're not going.
Yeah,
I don't think they're going to.
So it will be interesting to see how this goes forward. But this kind of happened last year too. Where you have this first part of the year, this first half of the year, where it's pretty laid out, and they got through their interest rate hikes through the first half of the year. And then once you take September off the table, I mean, you really start looking to December, and so you're lifting essentially 5 months of overhang until they can start jawboning and ramping it up. Maybe in November, that they're going to do it in December, if they're even going to do it in December. And we have so many potential black swans heading into the fall. It's a traditional markets go bump in the night period of time. I mean, there's so many things that could occur that completely derail that, and giving gold this period of time to be relieved of that interest rate overhang
To seek fair value.
Exactly. I think it's the right way to put it.
Yeah.
I mean, and so, and we have this kind of technical rebuilding going on, and it's moving into that, diminished expectation of September, that extra time into October and November for the gold price to, potentially seek, higher levels. So we'll see.
I think that's probably what we're seeing right now.
Exactly.
Yeah.
So, moving on to our golden gong this week. So I'm passing this out to Clive Mond, and he's actually had 2 articles that we've put up at our website here over the last week and a half, and I want to credit him because I put up an article for him last week. It was literally the only article that I could find that gave any prediction to it being a bottom in the gold market. I mean, everywhere, and it speaks to what you said. Fade the financial news, because everywhere you looked, it was 1130 gold. The market is falling apart. Retesting of the lows. We're right there. But Clive Mond comes out on July 11th, mind you, when gold was like 1216, so maybe $3 off the low, $5 off the low, and he said, gold's latest COT chart, Commitment of Traders chart, looks increasingly bullish, with large specs shrinking back dramatically, so that are now approaching the extremely low levels last seen at the December 2015 lows, meaning that we are either at or very close to a major bottom here. So that was his,
Good
quote.
call.
Good call, right?
Yeah.
I mean, here we are, $35 odd higher than when he made that call, when no one else would make that call. And, I think it's really interesting, too. I just want to provide some context to that, to think about that. The commitment of traders shows a level of bearishness, commensurate, or lack of bullishness commensurate with the 2015 low when gold was 1060 at 1210. I mean, just think about how productive that is in context. I mean, I think that was a remarkable moment. But then here in just a few days ago, so July 2015, so just 4 days later, and this was after gold had just started to begin its recovery, had a couple good days. He penned an article titled "Precious Metals Sector Update: The Biggest Opportunity Since Late 2015 and the Last Chance at These Prices." And in that article, he wrote, kind of giving some context, because debt and associated derivatives has expanded to such gargantuan levels that any attempt to bring it under control will send interest rates skyrocketing. Because of this stark reality, they are left with only one option, they being the central bank, to inflate away the debt away by monetizing it, which means inflation. And then comes his prediction. Once investors grasp the inevitability of this, and that this process will soon get underway with a vengeance, gold and silver will soar. This is what the charts that we are going to look at today are telling us, and it means that we may never see the bargains in the precious metals sector that are not now available ever again, or at least not for a very long time. That is a bullish sentiment,
Very
and
much
one that
so.
we appreciate. So to Clive Mon, the Golden Gong. Thank you very much for watching. I'm Jonathan Casares.
I'm Peter Grant.
See you next week.